Hi, everyone. Thanks for joining us this afternoon. We're just going to go through a little bit, I suppose, about group pensions and risk benefits this afternoon. We should be done in hopefully about a half an hour, 40 minutes. Tracy is joining me as well. It's unfortunately me that you're going to have to listen to for the next while, but okay, I suppose we'll just kick off straight away. I know there are a few people still joining us. So hopefully they won't miss too much. Okay, if I can get it to work. Okay, so just to give a little bit of background on Oaktree itself and who we are. So we would have commenced business in 2010. We've over 1,500 clients on the books at the moment, with over about 25 million in assets under management. There are 7 of us here in the office, and we deal with all of the leading life companies, alternative investment managers. And our goal is always to ensure the best possible solution for our clients, whether that is corporate or personal clients. We were awarded the All-Ireland All-Star in Personal Finance for 2018 and 19 and 19 and 20. And we've been working with group schemes of all varying sizes for the last 10 years as well 12 years really now at this stage. So today what I want to just cover off is what is a group pension and risk benefit scheme? What are the employer obligations? A little bit about auto-enrolment, given that it's so topical in the news at the moment. An overview then on group pensions and group risk, why you should offer a scheme, why you should use a broker, and I suppose we'll cover off then what happens next and any questions that may come up through the presentation. There is a chat box just at the bottom of the screen if you want to send your questions in through that, or there's a Q&A box there as well, so you can submit them in that way as well. So I suppose a group pension, just to explain what it actually is, it's a workplace pension scheme run by the employer. And the most common type of group pension is this defined contribution scheme, which is often set up as group personal pension that companies offer to its employees. There are various different types of ones. You probably have heard of defined benefit as well. Defined benefit is dying out a little bit. So what we're really looking at is the defined contribution, or DC scheme, that most companies would use now. You can have additional benefits or even standalone benefits in the scheme. So the first one of those would be death in service, which most companies and most employees would be aware of. And that pays a lump sum or a longer term income to the employee's family in the event of their death while they're employed by the company. Claims can be paid tax-free as long as the scheme has been set up properly as well. And that, I suppose, is one of the big things, is making sure that they're set up properly. The other one is income protection, group income protection, an insurance policy that will pay the employee's salary if they're unable to work as a result of illness or injury. And the policy can also cover the cost of pension contributions, which again makes it a huge benefit from the employee's perspective in the event of something happening to them. This is, I suppose, something that a lot of people are unaware of, is that there are specific employer obligations in place. Legislation was introduced in relation to this in 2002. So the employer must provide access for employees to at least one standard PRSA, where it does not operate a company pension scheme. If it operates that scheme, but the employees are not eligible to join for the first 6 months, they must be offered a PRSA. If the scheme only provides death in service benefits, the employee must be provided access to the PRSA. And if the company scheme doesn't provide an AVC facility, then an AVC PRSA facility also needs to be provided. And again, these are things that a lot of companies are not aware of and that they're not being told about. So if you're providing this PRSA facility, what is it you actually have to give to the employees? We call them excluded employees, mainly because if you have a death in service benefit, or if you have this restriction on them for the first 6 months of employment, this is where the excluded word kind of really comes in. So the employer must enter into a contract with a PRSA provider. They must notify the employees of their right to contribute to a PRSA. They must allow reasonable paid leave from work for these employees to set up a PRSA. They must deduct the contributions made by the employees under the net pay arrangement and apply tax relief at source. So that is essentially running it through the payroll of the company. And then they must remit these PRSA contributions to the PRSA provider within 21 days at the end of the month for which the contributions were made. They must also confirm that the PRSA contributions in the previous month have been remitted, again done through the employee's payslip, and ensure that the maximum contributions for tax relief purposes are not exceeded. Again, that's based on age and salary. So there are requirements there that employers really should be aware of and know what they need to do. The other thing here is that the employees, the notification that they must give to the employees needs to be done on a regular basis, so that they're not, it's not a, you know, you're notified at the start and that's it. It really should be something that should be done each and every year. The next thing I just want to cover off is auto enrollment. A little bit of where are we now? Again, this is something that has been topical for the last number of years and has really come to the fore in the last couple of weeks with Minister Humphrey's announcement. So what is it? What are we looking at here? So we're now looking at a new potential start date of 2024, and it is going to be targeting workers over 23 and under 60 on 20,000 euros or more. So there's about 750,000 people going to be included in this auto enrollment. There is a voluntary system to opt out rather than opt in. So if you are over 23, you can opt out after 6 months, but after 2 years, you will automatically be opted in. So there is going to be a little bit of an onus on companies to ensure that that is monitored. So if you have a member of staff who opts out after 6 months, you must remember that 2 years later, they have to automatically opt in. So it is going to be something that's going to be difficult, I guess, to monitor. Contributions are going to be paid via the old SSIA type model, but contributions from the state will only apply up to 80,000. Okay, so that's something that needs to be remembered as well if you have higher paid employees. Contributions will be paid to the CPA, the Central Processing Authority, and they're responsible for the overall administration of the scheme. Now, there are a couple of things, I suppose, that need to be remembered in relation to auto enrollment. I think what's really happening here is that it's more about coverage than adequacy. So it's about covering these 750,000 people as opposed to providing an adequate system, really is kind of the way we see it. Now, if you have already got a group scheme in place or one is set up before 2024, then you don't need to follow the auto enrollment process. I'll show you some figures in a couple of slides as well, and you'll see that for some employees, auto enrollment won't be as good as the current system. So there are going to be pooled returns under 4 investment choices available. So essentially those are conservative, moderate, higher risk is what they're called. And then the final one, the 4th one, is a lifestyling choice, which is based on your age at a particular point in time as to where you sit on an investment risk scale. Access is linked to the state pension age, which is currently age 66. I have an asterisk there purely from the point of view that it's currently age 66. That will change, or certainly has potential to change based again on the discussions that are happening at government level. What they've said is that the drawdown options under auto enrollment are going to be in line with pension and taxation law prevailing at the time and are going to be very much based on what's already there at the moment. So they're not proposing any new system for post-retirement. It's still very much based on the 25% lump sum, and then you either take your annuity or your ARF, your approved retirement fund option at that time. Again, there's a commitment that the current tax relief system by occupational and private supplementary pensions will remain unaffected by the introduction of auto enrollment. That's very, very good news, as you'll see in a slide or two later. So what's going to happen in terms of this is that employers are to match employee contributions and the state is to pay a subsidy to the employees. Contributions will be done on a 1 to 3 basis. So if you start off in years 1 to 3, so 2024, the employee must contribute 1.5%, the employer must contribute 1.5%, and the state will contribute the other 0.5%. And as you can see, going right the way through to year 10, where the employee will be at a 6% contribution level, the employer will be at a 6% contribution level, with the state contributing 2%. So overall, going into a pension pot for any employee should be this minimum figure of 14%. There's no requirement that the employee would put in any more, and there's no requirement that the employer would put in any more. But again, you already have quite a number of companies out there who are doing more than this. So the old system, the current system that they're in, will continue to apply. What I wanted to do was kind of talk a little bit about the tax relief versus the state contribution. So what we've done here is just look at the cost per €1 for a member saving into their pension scheme. So if you look over on the first column there, the higher rate taxpayer, so someone who's paying tax at the top rate, who wants to contribute €1 into his pension scheme, it's costing him 60 cents and the state are paying 40 cents into that scheme for him. Over on the opposite side, the standard rate taxpayer, so someone who's paying tax only at the lower rate, that 20% tax rate, again, the same euro, he will contribute 80 cents while the state will contribute 20 cents. So what you're showing here is the difference between those two people. Then if you look at the new system, this auto enrollment system under the state contribution, so a member is now going to be contributing 75 cents and the state is going to be contributing 25 cents. So you can see that a person who's on the lower rate of tax, the new auto enrollment system will actually be more beneficial because they will be having to contribute less to make up that same euro. But if you compare that then, if you have employees who are on the top rate of tax, this system is not going to be as beneficial for them because they're now contributing considerably more. So what you need to remember is that pensions, I suppose, are always kind of designed to attract people to your company. If you're using just the auto enrollment system and not using a group pension scheme that has been set up, then you could potentially lose staff on a higher tax rate to an employer who's already providing better benefits under the group pension scheme. So group pension schemes in general, again, we're just going to kind of go through a couple of things. They're generally set up under a trust or on a statutory basis. Statutory plans are set up by legislation and provide benefits for employees, mainly in the public sector and semi-state bodies. The trust is the one that's normally used for the private sector. So it's a legal arrangement used to establish the pension scheme under which trustees hold the assets for the pension scheme in a trust fund, essentially for the benefit of the members and their dependents when they actually get to retirement or in the event of death, whichever is earlier. In most cases, we can arrange for the trusteeship to be provided free of charge. This is something that I think will potentially come under review over the next couple of years with the changes to IORPS 2, but at the moment, that's the way it currently is. The big thing here is that there's no benefit in kind on the employer contribution to the scheme. That is different where it's a PRSA. So there is, if an employer is making a contribution to a PRSA scheme, there is a benefit in kind on that for the employee. So that needs to be also remembered. Other considerations is a contribution level. How much as an employer will you contribute to the scheme? That varies. It varies hugely. We have seen anything from 3% to 20% going in as a company, as the employer contribution into schemes. The executives, so a separate scheme can be set up for the executives of the business. That facilitates different contribution levels and also different investment strategies for the executives. So for senior management within the organization. Vesting rights, will the employee be entitled to your contributions, to the employer contributions to the scheme if they leave within those first 2 years? So what often can happen is if you set up the vesting rights that the employee is not entitled to the contributions, the employer contributions within those first 2 years, the employer contribution piece gets transferred back to the employer in the event of a staff member leaving. Again, you may have staff that have been there for a considerable number of years, and you may not want that to happen. You may be quite happy that they benefit from your contributions as well. Again, it's how it can be structured and set up at the start. Lastly, then, is just looking at the investment strategy. In most cases, this is taken as being a lifestyling choice for the scheme. So depending on where you are in your life, it will identify the type of risk that can be taken with your funds. So this is something, again, that we can work with you as the company, or even with the employees as they go through their life with the company. Just a little bit about group risk. So group risk is the umbrella term for 3 different cumulative benefit schemes, which are normally death in service, group income protection, and group critical illness. All 3 can be provided separately of each other as well, but it is something just to remember that they can be included all together. Typically, you would see the death in service and the income protection together. The death in service is the most common of these benefits, and it's paid to the beneficiaries of the employee. Separate dependents, death in service pension can also be provided. One thing I will say just in relation to this, where it's being paid to the beneficiaries of the employee, we currently have a situation where unfortunately a scheme member has passed away. There is no will in place, and there was no trust letter of wishes included within the company scheme as to where the funds should go, where the benefit should be paid to. In that situation, the spouse is now currently trying to extract letters of administration, which slows down the process in terms of accessing the funds, as she has to now wait for the courts to approve that letters of administration in order to access her spouse's benefits under the scheme. So just be aware of those kind of things. Typically what it does is it pays out a lump sum death, which is normally up to 4 times final remuneration. So again, it's very much based on the final remuneration that's in place for a member. It can be very cost effective for employers to provide these benefits. Generally, the premiums are paid by the employer, can be offset against corporation tax, and are not regarded as benefit in kind for the employee as well. So that's can be a huge benefit there as well. Again, just there's no benefit in kind on the employee. So death in service, again, the pricing is based on a mix of male or female lives, the occupation and the nature of the business in which the company engages, whether there's a claims history in place, and whether current staff are actively at work. So it's only based on current active at work staff. So if you have someone who's already out on claim or out of work through illness or injury, you know, that will need to be taken into account in the pricing. The underwriting, typically there is none, but some can be required if the member is not actively at work at the outset, or if you have a staff member or an executive who's on an exceptionally high level of salary that would require some element of underwriting. When it's set up and when it's put in place, there is this free cover limit applied to the overall scheme, which can be quite attractive in that it basically means that any new staff brought on which are under this limit can be included automatically and do not need to be, you don't need to identify them, or you don't need to wait until renewal of the scheme to actually have them covered. Income protection, so again, it provides a continuing source of income or replacement of a portion of the salary for employees out of work through accident or illness for a prolonged period of time. It also replaces any lost income where the employee has to take a part-time or lower paid position in the organization because of illness or injury. It's typically utilized by the employer to cover a promise of long-term sick pay to employees. And the benefits begin to be paid after what's known as a deferred period. And that's anywhere from 4 weeks up to 6 months. And again, as I said there, it's more commonly 6 months where the employer, in some cases, pays the employee for those first 6 months. And then after that, they go out on claim on this income protection plan. It's generally payable until the retirement date or when the person returns to work. So if you return to work, then it will cease, or it continues to pay until the retirement age. There are two elements to it. The member benefit is paid to provide the ongoing income, and there's also a premium protection element to ensure that in the event of a claim, the pension contributions, both the employee and the employer contributions, are covered. Again, it's of a huge benefit, so that if you have a member of staff who goes out, for argument's sake, at the age of 50, and they're unable to return to work, and they continue in claim until they're 65, there's 15 years there in normal circumstances where there is no employee or employer contribution going into the scheme, and that can make a massive difference to an employee's final pension. So adding this premium protection does ensure that those pension contributions are protected as well throughout. So how it's calculated, it's basically 75% of the salary less the state benefit. So it's currently around 10,500. And so what you're protecting is 75% less this 10,000. That's how much you can protect for an employee. Most schemes are typically set up on a 66% less that state benefit. Again, it's just one of the nuances of most schemes. The payment of benefits to members, the benefit is taxable in claim and is treated as subject to income tax, USC, and PRSI. Essentially, the person becomes an employee of the pension or of the life cover scheme, of the income protection scheme. So let's say if it's placed with Zurich or New Ireland or Irish Life, they effectively become an employee of that scheme. The insurers will always try to support the member with medical as well as financial support throughout that period of time, and will work with them in terms of trying to get them to return to work. And if they can return to work, then they will pay partial claims. So if you have someone who can return to work, let's say for 20 of the 40 hours, then the company is now paying them half their salary, and the balance is being paid by the insurance company. If there's a relapse, then the insurer will not impose any new deferred period. So if there's a relapse, the claim will kick off immediately. And pricing and free cover limits are very similar to that supplied under the death in service scheme. The final one then is the critical illness benefit piece of it. Again, it's not that common on most schemes, but it does pay a lump sum to employees on the diagnosis of one of a defined list of illnesses, or where they're undergoing one of the defined list of surgical procedures. As I said, it's not very common under most group schemes. It's paid only if you survive after a specified period as well. So why would you offer a group pension scheme or a group risk scheme? So essentially what you're trying to do in most cases is to attract key employees or retain key employees. And the most effective way of doing that is by providing a benefits package. In most cases, what we see nowadays is people are looking, well, what is the pensions and death benefit package that the company is paying or provides? Employee liability or loyalty, not liability, loyalty. A group pension scheme that includes an employer contribution is an indication to your employees that you are concerned about their current and future well-being. So while you can set one of these up without an employer contribution, we would always say, you know, you should include some element of an employer contribution just to show your commitment to the staff as well. It's also quite tax efficient. It does providing a group pension scheme is tax efficient. All the contributions to the scheme are available for tax relief against corporation tax. Separately then, The company owners and directors can be included for death benefits, even if they want to keep their pension benefits separate. So if they're doing an executive scheme in terms of their own pension scheme or pension benefits, they can be included for the death benefits under the main scheme. So if we have a quick look at the group scheme versus the PRSA option. So remember, the PRSA option is something that you must make available to all of your staff, whereas the group scheme is something that you voluntarily put in place. So the charges under the PRSA option are a 5% contribution with a 1% annual management charge. So the 5% contribution means that for every €100 going into the scheme, only 95 is being invested. That's what the 5% contribution means. With the group scheme, it is there's no contribution charge, and the management charge is often lower than the PRSA, ranging from somewhere from 0.6% to 0.85% typically is what normally happens with the group schemes. The fund choice under a PRSA option is quite restricted, so an employee is only able to access certain funds, where there's a much wider choice to facilitate lifestyling within the group scheme. If you're offering a group risk benefit, it has to be operated completely separately from the PRSA option, whereas under a defined contribution plan, you can actually provide both under the same scheme. There's no no trusteeship required under the PRSA option. It is required under the group scheme, but in most cases, it can be provided free of charge. Under revenue reporting, the benefit in kind, where the employer is making a contribution to the PRSA scheme, must be reported on a regular basis, whereas there's no requirements under the group pension scheme. The vested rights, so the employers are not entitled to any refund of contribution for less than 2 years service under a PRSA, and whereas the employees are only entitled after 2 years of pensionable service to the employer portion, if the employer so wishes. So I suppose one of the questions we would often get asked is, well, why would you use a broker? Why would you use us? So we do provide hassle-free group pension schemes implementation and management for all companies. And what you're trying to do is make sure that you have the employer guidance, the governance and trusteeship, and the member engagement looked after to create that perfect mix of a successful pension scheme. So on the employer guidance side, so you can already see we've kind of gone and outlined the PRSA options, the requirements, all of that kind of thing. So what we're trying to do is say to businesses, look, we can ensure that you make the benefits package as cost effective and non-time consuming to manage. So if you have a HR division, or if you're looking after these things yourself, our job is to take away the stresses of looking after these schemes and manage them in-house here. We help you as the employer to understand pension legislation, investment options, and what your competitors are offering as well is often a huge thing, so that we can explain, look, within the market that you're operating, the company is making pension contributions of 10, 12, 13%, whatever it actually is. We advise on the correct and most cost-efficient structure for your company. We help select the correct provider for you and ensure that the pension scheme performance is reviewed regularly, and make administration as hassle-free as possible by managing the selected provider. Member engagement, again, it's hugely important that once you actually put a scheme in place, that everyone actually understands what's there. So we do member presentations on the benefits, the investment options, the contribution levels, and what to expect at retirement. We offer one-to-one guidance on pension scheme benefits, literature and application forms for all new members, so it makes sure that they fully understand the benefits being provided to them by your company. And we also look at how they can maximize their personal contributions, again, to make sure that they are benefiting completely from the scheme. We also offer one-to-one member reviews to discuss their individual employees' funds and needs. And that we've felt has provided a huge amount of benefit to them in terms of, understanding their own financial situation. We're a direct contact to answer member queries, including dealing with members leaving and retiring, so issuing out the leaving service options or the retirement benefit options as they go. And then we, as I said, we do the individual financial planning advice. So basically what we try and do is that we're not just acting on behalf of the company as the financial provider for the scheme, but also that we're acting as the financial advisor to each and every staff member of the company to ensure that they know what they have and how they can best maximize their benefits under that scheme. The governance and trusteeship. So often employers do act as the trustees of their pension schemes, which means that they need to keep up with pensions legislation and that trustee training is completed every 2 years. There's a lot of requirements there, again, because of new guidance and new legislation that's issued under IORPS 2, it makes it much more difficult. So it is something that more and more companies are looking to exit from. So the Pension Authority can and do fine the trustees that don't meet their obligations. Again, we have seen quite a lot of those over the years where trustees are not completing forms or completing required paperwork on time and submitting it to the Pensions Authority or providing it to the members on request. So we can arrange pension scheme trustee services. And again, as I said, we can usually arrange that for free of charge. So we are actually providing the overall package to remove the trustee responsibility from the employer if required. So again, a lot of people would have existing providers in place. I suppose from our perspective, you know, one of the main reasons why they change is actually not poor investment performance or the high fees or hidden charges. It's actually poor levels of service. This is one of the main reasons that we have seen over the last couple of years where we've been brought in to take over a scheme. It's to do with when a company is actually in need, right? So you have a situation where you have a staff member who's going out on claim under income protection, or you have a staff member that has unfortunately passed away while in your employment, and the claims process needs to be dealt with. You know, that we're there, we're the go-between, we're the ones that you come to with any of your questions and queries, and that's a huge piece of this. So while there might be poor investment performance, it's actually service and how the staff and the members of the scheme feel that they're treated by the provider. That's a huge thing. And again, as I said, because we would be sitting in the middle of that, we can ensure that that's all managed. In some cases, there are very complicated structures put in place by the providers to deal with these higher fees. And that can lead to very little transparency for the members. And there are no annual reviews provided, or if there are, they're being provided in a very obscure way. That is pretty much the presentation in full. I just wanted to put up this last slide, which deals with the geopolitical events and subsequent recovery. So one of the things that we get asked an awful lot about, especially over the last couple of weeks, with everything that's happening in the Ukraine and the war that's going on over there, you know, how long will markets be down? How long have markets been down in the past? So what we did is just prepared this kind of schedule, which shows where things were in terms of market recovery. So the market shock, if you look at the very first one there from COVID, so it took 63 days until it reached the very bottom of the market. And in total, from once it started the downturn till it reached a new high was 148 days. So given, I suppose, the fact that COVID has been an ongoing pandemic for over 2 years now, 148 days is not actually that long in terms of a recovery. If you go down along the list, you can see the London tube bombing. Again, markets crashed almost immediately, but it was 4 days later when they recovered. The Iraqi invasion of Kuwait, 71 days to the bottom and 189 days for full recovery, so just over 6 months. Pearl Harbor, I suppose, was probably the longest one. It took 143 days before markets actually hit the bottom, but 300 days, so just under a year for it to actually fully recover again. So I suppose what I'm trying to say is, yes, while markets are currently down at the moment, They have stabilized significantly over the last couple of weeks. How long will it take for them to rise back up again? You know, I suppose as anyone's guess, it depends on how this plays out over in the Ukraine. But it does, I suppose the purpose of this slide is to show that in all situations, markets do recover. The next piece of just what happens next. So again, for anyone that has an existing scheme, make sure you're happy with the provider. If it's a new scheme, make sure you understand what your employees want and engage them in the process, and make sure that you are currently satisfying your obligations as an employer in relation to that PRSA offering. Get clear advice of what's included in your scheme. Again, that's another big one. There's an awful lot of people that don't understand what's already in their schemes. And as always, we would recommend you seek professional advice. So that is pretty much it from me. I think I did fairly okay. I think we're currently sitting about 35, 36 minutes. So I'm sorry if I've rattled through it a little bit too much. But if there's any questions, please feel free to ask us.
I have two questions here, Adrian, that has come in. And yeah, they're all actually over the auto enrollment. So one of the question was in relation to the opt-out after 6 months. Are those payments then refunded?
No. My understanding is no.
They have
My
to
understanding
remain.
is that they will remain within the under the CPA control until you actually retire.
Okay, and the last question that I have here that came in was, can you have a company group scheme and run it alongside the state auto enrollment scheme? Is that going to be possible?
I don't see why it wouldn't be possible. I suppose the question more would be, why would you do it? Because if we go back, let me just go back here to one of the, sorry now, I'm a good bit back.
Well, just looking at, you know, the slides that you were showing there about the different contributions
the
on the taxpayers, yeah.
This one, like, I suppose if you're a higher rate taxpayer, earning anywhere over 35, 36,000, you're going to be able to avail of the of this one here, this higher rate element to it. So why would you kind of run the two together? I'm not sure that it would be beneficial to do so. Might be at a very kind of, if you're borderline on that, you know, kind of under the 40,000 figure, it might be borderline, it might be some way beneficial, but I don't see that it would be overly beneficial to do that.
Yeah, I don't know the details about, you know, the company that they're particularly referring to, but like, I know all these details will be ironed out, obviously, as the system becomes more clear.
Yeah,
but like, if you had a company that had, you know, say a number, say over 100 employees in it, whereby 50% were on the, you know, on the standard tax pay of 20%,
yeah,
and the other 50% were, you know, in the 40% tax bracket.
Yeah.
Wouldn't it make more sense? Like, you would think that would make more sense to be able to run possibly two.
It would. It would almost be, and again, I suppose this is probably something that hasn't been specifically identified, but I would imagine it's almost that the people in the higher rate tax bracket would be classed as within the executive pension scheme piece of it, maybe. It's probably, it's a very good question, actually, because it's something I hadn't really kind of considered. But yeah, it's probably something that will need to be looked at. I can't see a reason why you wouldn't run them side by side. It will just depend on whether the CPA allow that.
Yeah. As far as, and this is my question, as far as, you know, setting up these auto enrollment schemes, you know, at the moment now, to get revenue approval on the company schemes, it does take a number of time. Is there a lead up time for companies to, you know, to start looking into these schemes, or what would you say about that?
Well, okay, first of all, I think January 2024 is hugely optimistic. you know, I'm not sure we'll hit that date. I think if we do hit that date, it's going to be a very bumpy start to it. The CPA is going to operate on a very similar situation, I think, to the construction worker pension scheme. So anyone was ever involved in any element of construction over the years will know that the CWPS scheme was not a great scheme. It's quite badly managed. And my biggest fear is that you're going to end up in the same situation here. So as I said, this is more about coverage. It's more about providing, it's more about Ireland saying, look, aren't we great? We've followed this auto enrollment, and we now have maybe 75% of our adult population, you know, paying into a scheme, rather than actually creating an adequate scheme. So you have people that are paying into this construction workers pension scheme, you know, maybe €2 or €3 a week going into it, that thought that they were going to have an absolutely massive pension after 20 years. It doesn't happen. You know, in order to get a pension out, you have to put a pension in. Is basically how it has to be done. Yeah, I don't know. I think you know, I think if any company is on the fence about what they want to try and do, and obviously this is us selling our own services here, I really do think if you have staff on earning that higher rate element, and you're going to have to contribute anyways, I would be doing it as a group scheme, because the member is now having to pay less. Again, based on this slide, the member is much better off at a higher tax rate than under the auto enrollment piece of it. And I think for companies that you know are kind of, I suppose, again on that fence, they need to take that into account, because if you have higher rate taxpayers as part of your organization that are going to pay less net into a pension with another company, you know, you have to think about that. You know, are you going to be able to retain them?
And that's it all from my end. So yeah, thank you.
It was probably a little bit of a waffly answer, but yeah, sorry about that.
Well, thank you for everybody for attending.
I think that's kind of that's pretty much it. I think unless there's anything else.
No, nothing else came in from this end, at least.
Okay, super. All right, guys, thanks very much for everyone for attending. I know Adrian is going to be sending this out to a few of you. So if you do have any questions, please feel free to contact us afterwards. Thanks very much.
Thank you. Bye-bye.